Hello, hi. My name's Jerry from Trendsignal, the trader education company. This week we're going to refocus our attention on inflation, and this particular week it's the release of US CPI or US inflation data, and this is something that obviously that's driving the Federal Reserve, the US central bank, in setting rates. And obviously it's not just affecting the UK, the US, the UK here. We've got rates going sharply higher, sterling crumbling. We've got rates going higher in the European Union or Eurozone, with ECB putting up rates. So it's happening globally. It's not just US focused, but it's the US inflation rate does drive Federal Reserve, which drives US interest rates, which affects the dollar, and that really affects a lot of commodities and other markets. Without further ado, let's have a quick look at where the market was last week. We had something called non-farm employment, which is the US employment data that excludes the farm sector. That's why it's called non-farm, which is very seasonal, so they don't include it. But the data was, yeah, it's stronger than expected, but not wildly stronger. Certainly not on the number of new jobs that were created. 263,000 new jobs in September, when the market was looking for 248,000. So ordinarily, that's not such a big deal, really. But I think it was the headline unemployment rate of 3.5% that really caught the eye, and this fell from a previous read of 3.7%. So you've got to ask yourself, well, if the number of new jobs wasn't that much bigger than expected, why did the unemployment rate drop from 3.7 to 3.5? And I think it's a combination of the new jobs, but also it's a factor of the number of people leaving the jobs marketplace effectively, those people taking early retirement, those people just deciding not to look for work anymore. And so you've seen that labour, the unemployment rate fall to 3.5%. And that really does sum up the labour market, though. It is quite a tight labour market, and it's not something that is going to encourage the Federal Reserve to start taking its foot off the path or pace of rate increases. And that's the reason why the market fell quite sharply, with the S&P falling 2.8% on Friday, the Nasdaq, with all its tech stocks, falling 3.8%. So these are big moves. But actually on the week, still in positive territory. The S&P was up 1.5%, Nasdaq was up 0.75%. And our FTSE up sort of just shy of 1.5%. So it wasn't all bad, but unfortunately the mood is quite gloomy. And with what's coming out this week, all eyes will be focused on this inflation data. So um, yeah, now I want to talk about inflation in the path of U.S. interest rates. So what happened on Friday resulted in a bit of a reaction by the money markets, and as to what they're expecting or anticipating will happen with interest rates. Um, we're now expecting that interest rates are likely to be raised by 0.75% in the next meeting on the 2nd of February. Sorry, 2nd of February, 2nd of November, and then by another 0.75% in the December meeting. Let's just have a look at that FedWatch tool provided by the CME, and I can explain it more clearly. So this is quite a handy graph that the Chicago Mercantile Exchange put together on the basis of their Fed fund rates that are traded on the exchange, and it tells us what's going to happen at these meeting dates. And what we're looking at here is the meeting on the 2nd of November. Currently, interest rates are at 3 to 3.25%, and you can see there's a 80% probability of interest rates going up to 3.75 to 4%. So that's an increase of 0.75%. And you can see actually at the bottom down here how that percentage has changed over the last, well, day, week, and month. And you can see there's been a marked change over the last week, with 81% probability of a rate rise of 0.75%, whereas a week ago it was only about 60%. More interestingly, if you go to the end of the year, the last meeting on the 14th of December, there is now a 21% chance that there's going to be a 1% hike in rates on the final meeting of the year on the 14th of December. That's the reason why the markets fell, people. Interest rates are not good for business. They might tackle inflation and subdue economic activity and help to control inflation, but markets don't like it. Hence the big moves that we saw. Let's just get back to my presentation. So now I just want to look at the outlook, short-term outlook for US and global markets. quite a big topic, and you think, well, how can I cover off much on that? Well, it's interesting the way the markets have behaved last week. Clearly, they're sensitive to anything that is going to prevent the Fed from slowing down or pivoting on its interest rate path. What I mean by that is, is it likely that data is going to enable the Fed to take their foot off the accelerator a little bit and not raise rates by what the market is anticipating? Obviously, the data on Friday, the non-farm payroll, is what caused expectations to firm up for some quite aggressive rate rises from the Federal Reserve up to the year end and beyond, actually. And so any data that can perhaps cause the markets to believe that the Fed won't raise rates so much is going to help. Um, um, so for the time being, in terms of the outlook, I think the outlook, it really hinges on what the data will be like on Thursday, this US CPI inflation data. And we're expecting a figure that is somewhere around a bit weaker than last month. Last month was a bit of a surprise. The analysts were calling for a figure of about 7.9. It came in at 8.3. This month, we are expecting the rate to fall back from 8.3 to 8.1. And obviously, US markets and global markets are very sensitive to this for the reasons I've outlined previously. The core reading is the one that the Fed will look at quite closely. This actually excludes food and energy, which are the main reasons why the inflation rate has gone screaming higher. But if you exclude food and energy, you actually get to the sort of underlying core rate that's almost building up in the system regardless of energy, and it's that the Fed want to make sure they keep in check. So they'll be particularly sensitive to that as well, the Fed, and also global markets. So I think in the very short term, um, the markets will react to anything that suggests that rates may not be raised so much. I think it's unlikely that the markets will be forced even lower um, if the inflation rate comes out as expected, or even a little bit firmer. I think the data generally will be interpreted in a way that the market knows the bad news. It's looking for some good news for the time being. Um, so anyway, that's really what's going to happen this week. As I said, the key data that comes out Thursday with the 1:30 for the CPI data. Thanks very much. That's it. Bye now.